worth looking into as far as real estate investment. And I was going to try to make that a 10 or 15 minute video. That turned out to be 48 minutes. So that's not going to work long term. So what I'm going to do is I'm going to break these videos down to more bite-sized chunks, try to make them about 10 minutes so you can go ahead and consume them quickly and get the content that I'm trying to deliver, and hopefully we can add some value there. So let's go ahead and take a step back. And what I'm going to address today is specifically what I do first, and that is look at the debt to GDP ratio of the individual country. And let's figure out why that's important and why you should be doing that right now. So let's get right into it here. I've got this page pulled up on 10 reasons. Oh, let's see here. What's the title? 10 reasons why the national debt matters. And this is pertaining to the United States, but although the United States is unique in the sense that it's got the reserve currency, most of these 10 topics or 10 issues are relevant to other countries as well. Now, I looked all over the internet and I couldn't find a perfect article on this to discuss. I felt that would be easier to go over and comment on an article than it would be for me just to kind of try to walk you through my notes. That gets a little bit tricky, and I thought this would be a way for you guys to consume the content and make it a little easier to digest. The problem with that is I really couldn't find an article that I thought was any good. In economics, they've got two main schools of thought. You've got the Keynesian school of economics, and you have the Austrian school of economics. And it becomes very much like politics in the United States, where the left, they think they're right no matter, just because someone is on their team, and the right, they think that some individual's right just because that person may be on their team. It gets a little unproductive, to say the least. So I try to filter through that and get right to the bottom of the topic and try to really get into the nitty-gritty and pick out the information that we really need to make decisions. So let's go through this here. We've got number one, the national debt is a bipartisan priority for Americans. Nearly 3/4 of voters, 74%, agree that managing the national debt should be a priority, including 71% of Democrats, 76 independents, 73% of Republicans. Okay, so that, I guess, really doesn't matter for what we're doing here. Let's skip to the second one. The return of trillion-dollar deficits. The Congressional CBO, Congressional Budget Office, projects that the budget deficit will rise from $897 billion in 2019 to $1.4 trillion in 2029. It'll probably actually go up higher than that, but resulting in cumulative deficits of $11.6 trillion over the 10-year period from 2020 to 2029. So why is that? Let's distill this a little bit here. Why is that important? Because out of the total budget for the federal expenditures, you've got a certain percentage going to running the government, to national security, military, to infrastructure spending, to Medicaid, Social Security entitlement spending, and then you've got a percentage of that going to interest. Well, the bigger percentage going to interest, the lower percentage that you can spend on things that actually have a multiplier effect. A highway, as an example, you build a highway, and because of the commerce that it creates, the government actually gets a return on that investment. Where if you're just paying down interest on debt, there's no return on that investment as far as just the specific interest payments. So you could imagine what would happen in a scenario where the national debt got so large that 100% of the receipts coming in from the taxes, or 100% of the revenue that's coming into the federal government went to pay just the debt, or the debt reduction, or in this case, just the interest on the debt. There would be no other money to spend on entitlements, to spend on military, running the government. You would be in a very, very severe situation where the only option would be to print more money, which would put massive pressure on the currency, and the economy itself would really implode. You'd have like a Venezuela type situation. Maybe not that bad, but it would be, or maybe Greece is a better example of that. So that's not good. Let's go down to the next one. Key investments in our future are at risk. Higher interest costs could crowd out important public investments that can be the fuel growth. Okay, so this is basically what I was just kind of what I expanded on, and that's that if the government is paying down, or not paying down, but paying a lot of its total budget on interest payments, it doesn't have money to put into infrastructure spending. And that, okay, so and then how does that relate to us? Why do we care as real estate investors? Because that hampers growth in the economy, that affects housing prices, and that creates malinvestment, which can create a recession, and again, putting downward pressure on home prices. So that's why we care as real estate investors. Also, if a lot of if our assets, our real estate assets, are denominated in that currency, and that currency is losing value, that's something that we should care about as well. So number one, it could affect the appreciation of our asset because the economy at large is going into a recession. Therefore, there's less purchasing power, therefore less demand for our properties if we want to sell it. Number two is it can put pressure on the currency, decreasing the purchasing power of the currency that your assets are denominated in. So again, that's why we care as real estate investors. Let's keep going here. Rising debt means lower incomes. Again, what I just said, if the incomes are decreasing, then the purchasing power of your buyers for your real estate or for your rental properties is decreasing as well. Less flexibility to respond to crises. So what happens if you've got a country where the debt to GDP is 50%? Well, they've got a lot of wiggle room there. They can issue bonds, they can sell debt, and they can kind of boost the economy when the economy is going into recession to fight that. If you've got a country, let's use Argentina as an example, they cannot sell that many bonds to paper over any type of recession because the interest rates on their debt is so high because their debt to GDP got so extreme. They couldn't pay back their debt, and a lot of their debt was denominated in dollars. So once their currency started to tank, a lot of their debt was in dollars. That increased the price of that debt in terms of pesos or the Argentinian local currency. So again, I'm trying to go faster here and not really get too much into the weeds, but why you should care as a real estate investor is because if a government has more ammunition at their disposal to counter the effects of a recession, that's going to stabilize home prices. That's really the bottom line. Okay, protecting the essential safety net. So this is just, and you can tell this person's a Keynesian just by what they're talking about here. But this is basically if the government is spending too much of its money or too much of its annual income on paying interest on the debt, that's going to be money that's going to have to be taken away from somewhere else, most likely entitlement spending. A solid fiscal foundation leads to economic growth. Okay, so this is something that I'll expand on in more detail, but let's go ahead and read this. A solid fiscal outlet provides a foundation for a growing, thriving economy. Putting our nation on a stable fiscal path creates a positive environment for growth, opportunity, and prosperity. With a strong fiscal foundation, the nation will have increased access to capital, more resources for private and public investment, improved consumer and business confidence, and a stronger safety net. I completely agree with this. This is spot on. And I'm going to dive into this a little more detail once we get my notes. But again, if you've got a low debt to GDP ratio, you're going to create an environment that's much more conducive to the private sector growing. If the private sector is growing, that means there's more demand for housing. Many solutions exist. Okay, we're not going to really dive into that. That doesn't matter too much for what we're doing. The sooner we act, okay, this is just kind of a call to action here for the United States. So I'm not going to get into that. Let's go into the next article here. I'm just going to check our time, which I think I'm already at 10 minutes. Okay, so let's go through this quickly here. I want to focus on, and this is an Austrian economist who's actually really good. His name is Bob Murphy, and he writes for the Mises Institute. And what I wanted to highlight here is this paragraph. When the government buys 1 trillion more than it takes in as tax revenues, meaning the deficit is $1 trillion in this example, it diverts real resources out of the jurisdiction of the private entrepreneurs and into the politically directed channels. Ultimately, it is not deficits per se, but total government spending that distorts the economy and starves the private sector of resources. But deficits are insidious because they give the illusion of freebies in the near term, and the reckoning comes with vengeance down the road. Spot on. I know that's a little wordy, and it's got some economic lingo. So if you're not, if you're not an econ nerd like I am, it might be a little tough to understand. So let me try to explain that in layman terms. Basically, if the government is purchasing more stuff out of the economy, that means it's going to be less stuff out there because resources are limited. So let's use steel as an example. If the government is buying up a bunch of steel, well, that's going to be less steel that's available for the private sector. And if the private sector needs that steel, that's going to distort the price. It's going to bring the price up. Why does that matter? Because historically speaking, the private sector is much, much better at allocating resources than the public sector. How good is FedEx? How good is the U.S. Postal Service? It's just 9 times out of 10, the private sector is going to spend money and utilize resources much, much better than the government is. And that goes, that's the same whatever country you go to around the world. So what that means is that if the government is taking resources out of the economy, it's fewer resources that the private sector can leverage, and it creates a price that's higher for the private sector to obtain those resources. So that's something that's very, very important and very few people talk about. And that's why I wanted to bring it up here. And then he ends with, but deficits are insidious because they give the illusion of freebies in the near term, and the reckoning comes with a vengeance down the road. That's very important too. So let me explain that here. So the deficits in the near term give the illusion of growth because the government is spending that money into the economy. So GDP looks like it's very high. The problem with that is that generally when government spends the money, there's not a big multiplier effect. So you don't get a return on that investment. Let's look at this in terms of your business. Let's say you have a business where you produce a widget. Well, if you take on debt to produce a widget or to buy machines, let's say, to produce more widgets, well, you're going to get a return on that investment. But if that business takes on debt for the owner to go out and go on a vacation or to buy a fancy automobile, then there's not a return on that investment. So that's why, but if there's $100,000 that's spent on a machine to produce more widgets more efficiently, and $100,000 is spent to buy a new Ferrari, well, for that year, the GDP is going to increase by that $100,000. There's no differentiation between GDP that's spent on Ferraris and GDP that is spent on machinery to produce widgets better, faster, cheaper. So that's why he says that the deficits are insidious because they give the illusion in the near term of GDP growth, but in the long run, you don't have anything to show for it. It's basically a sugar high. And this really pertains to the United States right now, because if you look at all the growth, that Trump likes to talk about, that the percentage of GDP growth in the United States is less than the deficit spending. Said another way, it could very well be that if the United States did not take on such huge deficit spending, that the GDP would not have grown at all, meaning 100% of the GDP can be attributed to deficit spending of the federal government. That means the private sector didn't grow at all. Let's get into I know I'm running late here again, so let's just get into my notes, and let me go over this quickly so this video is more consumable, not 48 minutes. So just in summary here, negative effects of high debt to GDP for a country. This slows growth. It creates, in the long term, it creates less demand for the currency, and less demand for housing. Less demand for the currency creates an environment where the currency could depreciate. You could have less purchasing power in the currency that your assets are denominated in. It creates malinvestment, which means if the government is investing in things that don't have a multiplier effect, that don't have a long-term benefit. So you have a boom and bust cycle, meaning you have this big boom when all the money is being spent, but a big bust when there's no more money being spent, when the spigot is turned off because the money wasn't spent in creating assets that produce a return, such as the example that I used with the machine to produce widgets compared to the Ferrari. It produces higher percentage of GDP coming from the public or non-producing sector, which is what I just talked about. More debt equals higher debt payments will give government less to spend on the things to produce a return on infrastructure with the multiplier effect. We discussed that in this in the top 10 reasons here. It creates a scenario where only way out is negative for currency or economy, meaning the only way out is higher taxes, inflation due to printing over money, which becomes a government's only option. Higher interest rates on long-term debt means higher interest rates on mortgage, which puts downward pressure on housing prices. So the grand takeaway from all of this is that higher GDP or higher debt to GDP ratios put downward pressure on the purchasing power of the currency and potentially downward pressure on housing. So look for countries for low debt to GDP ratios. And if you have a comment, or if you have a question or a comment, make sure you leave those below, and I'll try to answer those as quickly as I can. And stay tuned next Saturday for another video on this topic that will hopefully be closer to 10 minutes. You guys enjoy your weekend.